Hi, I'm Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr. SNS Rajashim College of Arts and Science. In this video, we are going to see about derivatives. So, what do you mean by derivative? The term derivative indicates that it has no dependent value. Its value is entirely derived from the value of the underlying asset. The underlying asset can be a security or a commodity, a bullion, currency, livestock, or anything else. The Securities Contract Act 1956 defines derivative as under. It includes securities derived from the debt instrument, share, loan, were secured or unsecured, risk instrument or contracts for difference of or any other form of security. A contract which derives its value from the price or index of price of underlying asset. There are two types of derivative, commodity derivative and financial derivative. First, derivative originated as the tool of managing risk in commodities market. In commodity derivative, the underlying asset is a commodity. It can be agriculture commodity like wheat, soya bean, cotton, or precious metals like gold, silver, etc. The term financial derivative denotes a variety of financial instruments including stock, bonds, treasury bills, interest rate, foreign currencies, and other hybrid securities. Financial derivatives also includes futures, forwards, options, and swaps. So, features of a financial derivative. It is a contract. Derivative is defined as a future contract between two parties. It means there must be a contract binding in the underlying parties and the same to be fulfilled in future. The future period may be short or long depending upon the nature of contract. For example, short-term interest rate futures and long-term interest rate futures contract derives value from the underlying asset. Normally, the derivatives instrument have the value which is derived from the value of other underlying assets such as agriculture commodities, metals, financial assets, intangible assets. Value of derivative depend upon the value of the underlying instruments in which they are. So, specified obligation in general, the counterparties have specified obligation under the derivative contract. Obviously, the nature of obligation would be different as per the type of instrument of the derivative. For example, the obligation of the counterparties under the different derivatives such as forward contract, future contracts, option contracts could be different. Direct or exchange traded. The derivative contracts can be taken directly between the two parties or through particular exchange like financial future contracts. The exchange traded derivatives are quite liquid and have low transaction cost in comparison of tailor-made contracts. So related to notional amount in general, the financial derivatives are carried off balance sheet. The size of derivative contracts depend on its notional amount. The notional amount is the amount used to calculate the payoff. For instance, if the optional contracts, the option potential loss and potential payoff both may be different from the value of underlying share. Delivering of underlying asset not involved. Usually in derivative trading, the taking or making of delivery of underlying asset is not involved. Rather, underlying transactions are more settled by taking offsetting positions in a derivative themselves. There is therefore no effective limit or quantity of claim which can be traded in respect of underlying asset must be used to defer delivery. The derivatives are also known as deferred delivery or deferred payment instrument. It means it is easier to take short or long position of in derivatives in comparative to other securities or assets. So secondary market instruments, derivatives are mostly secondary market instruments and have little usefulness in mobilizing fresh capital by the corporate world. So exposure to risk. Although in the market standardized general and exchange trading derivatives are increasingly evolved, however, there are still so many private negotiated customized over the counter that is OTC traded derivatives are in existence. They expose the trading parties to operational risk, counterparty risk, and legal risk. Further, there may also be uncertainty about the regulatory status of such derivatives. Off balance sheet items. Finally, derivative instruments, sometimes because of their off balance sheet nature, can be used to clear up the balance sheet. For example, a fund manager who is restricted from taking particular currency can buy a structured note where coupons is tied to perform of particular pair. So now coming to the uses of derivative. Risk aversion tool. So derivative is one of the important services provided by the derivative are controlling, avoiding, shifting and managing effectively different types of risk through various strategies like hedging, arbitraging, spreading. Derivatives assist the holders to shift or modify suitably the risk characteristics of their portfolio. Predictions of future price derivatives serves as a barometer of future trend in prices, which result in the discovery of new prices both on spot and future market. So it enhances liquidity. As we see, the derivative traded are immediately full amount of transactions required since most of them are based on margin trading. As a result, large number of traders, speculators, arbitrators operates in such market. So integration of price structure, it has been observed of the derivative assist investors. The derivative assist investors, traders and managers of large pools of funds to diverse such strategy. So they have made use of the proper allocation. Calculus growth of financial instrument. The derivative trading encourages the competitive trading in the market, different risk taking preference of the market operators like speculators, hedgers, traders, arbitrages, resulting in increase in trading volume in the country. Bringing protection in market. Lastly, it is observed that derivatives trading develops the market towards complete market. Complete market concept refers to the situation where no particular investors can be better off than other, or pattern of return of all additional securities are spanned by the already existing securities in it. So these are all the benefits or the features of a derivative.